Going to go over some details real quick, and I hope not to lose you in the details, but I think these are important. These are unilateral contracts, meaning you. The only reason, and once you're approved, the only reason a company can cancel your policy is for non-payment. Okay? If you don't pay the premiums, they will cancel your policy. Most policies, when any good agent that is selling a policy to you will more than likely have a waiver of premium. So after you start receiving care, you are no longer liable or a family member for the premiums. And they also, when you sign up, actually have you pay most of the time for 2 months, a month in advance, just to keep that. They also offer draft straight out of your checking or savings account so that you won't have lapse of coverage. These are portable, meaning that you can go anywhere within the United States. You cannot go to other countries with most of these policies, but within the United States you can receive care. Like I've said before, they are comprehensive. They cover, they're not like the ones that were sold in the 80s that were just nursing home care. They cover a multitude of different products. They are guaranteed renewable. This means that every year your product is going to continue, okay? This does not mean that your rates are going to be fixed. Now, the products that I sell and many others have a rate guarantee, and those are important because they're not going to say, hey, you, Karen, we're raising your rates, okay? They're not going to do that. What they can do is just like your car or homeowner's insurance, they can say, every female in the state of Alabama that is between 45 and 52, we're raising your rates 3% or 5%. They can do that legally if they do an across-the-board rate increase. Majority of the time, companies will advertise that they have never had a rate increase. We've never had a rate increase. And I'm going to talk a little bit more about marketing here in a second. But you need to keep in mind that that's not necessarily the case, okay? That's not necessarily the case. We also, I'm inflation riders. I personally will not sell a policy without an inflation rider. You want to understand what inflation is? In 96, gas was under $1. In 2007, gas is nearly $3. That's inflation. The buying power of your dollar. I had my grandfather bought one of those burial policies, paid for 15 years on that policy, and it did not have an inflation rider on it. So when my grandfather passed away, where he thought he had taken care of his funeral expenses, they got to the funeral home, and that policy only paid $250. And he had paid $15, $20 for 15 years. Okay? So the buying power of that inflation, if you're younger, you need to consider a compound inflation, which I know you understand compound interest if you have a credit card, but it works for you instead of against you. So that every year, your bucket of money essentially is what you're buying when you buy a long-term care policy. Your bucket of money is going to go up every year. Guaranteed rates, like I said before, you can lock in to the price that you start paying, and you can guarantee that rate for the life of the policy if you choose that rider. Quickly, products are flexible. Most times when I choose a policy to sell, the elimination days, that's how many days can you afford to pay for yourself. Normally, I choose 90 to 100 days because that's 3 months worth of care. Most of the time, the Medicare, if you're covered by Medicare, that will pay up to 100 days if you qualify. And if you're of working age, I assume that you can pay for 100 days, 3 months worth of care. Okay? We've already talked about inflation riders. You do need to keep in mind that the inflation riders can add anywhere from 25 to 40% of the total premium, which is quite a bit. The days of coverage, which is the bucket or pool of money that I just mentioned, there are multiple payment options. You can do monthly, weekly, quarterly, yearly, or even a single pay where you pay one time for a policy paid in full at one time. You can pay up I'll pay up my policy by age 65, paid up in 10 years, 20 years. There's just tons of ways of doing that. Waiver of premium, I already mentioned earlier, waives the premium for your policy if you choose. Some policies have that automatically into the policy. Some have them as a rider. Okay? Restoration of benefits. There are riders that have essentially you buy your $100,000 bucket of money or whatever your bucket of money is that you pay for, and you use that policy. You have to go into a nursing home or an assisted living, and say you use it for a year, and $30,000 of your bucket of money is gone. You're down to $70,000. There are a lot of companies that will offer a restoration of benefits where if you are healthy for 6 months or more, they will restore your policy to the original $100,000 bucket of money, which is nice. Downgrades of policies. Remember, you can always go down on your policy. If you start and say, hey, I want a $300,000 bucket of money, and then later on in life you say, I've gathered enough assets or I have other things that are taking care of this, and I want to lower my benefit, you can. You cannot, however, increase your benefit. If you call up a company and say, hey, I want my long-term care policy to go from $100,000 to $300,000, they're going to want to underwrite you again. They want to know why this person all of a sudden wants more coverage, because more times than not they feel that something's wrong with you. Okay? Non-forfeiture benefit. One of the questions I get asked more times than not, and it just amazes me, am I going to get any cash benefit out of this? Does this have a cash benefit? For the most part, no, it doesn't. And people say, well, you mean I'm just throwing this money away? No, you are buying peace of mind. You are protecting your assets, your nest egg, and your family members, and giving yourself freedom to choose where you go and how you're cared for. Okay? So this is not just throwing money away. The majority of the insurance you pay for, your car insurance, your homeowner's insurance, cancer policies, disability, none of those are cash-bearing policies. Universal life or whole life insurance are really one of the only, and some annuities are the only forms of insurance that have cash benefits. So when you go to purchase this, do not expect to get any kind of cash benefit off of it. Quickly, if you already own a policy, should you switch? Most times you should not, because you've already made it through underwriting. And in the last 5 years, policies have increased quite a bit of what they cost. When I started in 2001, I could sell a fully loaded policy for $30, $40. Now that same policy is $100. Okay, part of that is inflation. Part of that is that there are more baby boomers taking care of not only their parents, but there's more baby boomers that are actually going into assisted living, nursing home, and in-home care. So more times than not, you should keep the policy. If you already have been approved, you should keep the policy that you have.